Good morning, ARMR Insiders. Welcome to the ARMR Morning Meeting. I'm Brett Rosenthal. We're going to talk about the stock market. We're going to break this conversation into three parts. Our trading posture, how we're going to be day trading. I'm going to share with you again another successful day of trading the indexes using spot gamma locations. And today we're going to focus on the small caps because it was such an obvious setup yesterday. And I tried to share with you really a kind of like a 1, 2, 3-step process of using gamma information to put on a long position to capture alpha. So I'm going to walk you through that. We're going to talk about the big issue on the table, which is the market up something like 5% off of the lows in the last, 4 or 5 trading days, which is, one of the biggest moves in a short period of time for the year in the market like that. So we're going to talk about how that changes the risk monitor and what it means for the ARMR portfolios. We have 4 of them, and I'll walk you through what the change on the risk monitor means for how we run money. And then I'll just share with you a handful of targets that are on the top shelf of our list of stocks we might want to own or groups we want to own. So let's get to it. Dive right in. Don't forget, you can always subscribe to the channel here if you want. By clicking on the subscribe button to this YouTube channel. Certainly the ARMR report is open to all of you. So if you have an interest in becoming an ARMR insider, take a look at the website. I share with you information about how I run my own personal capital. So certainly not a recommendation for you to run out and do something. I don't know you. I couldn't possibly tell you what stocks to buy. So you got to do your own due diligence. You got to figure out your own risk tolerance. But I will share with you my process, something I've been working on for over 30 years, running my own money and running capital for other individuals. And it's just a 3-stage process. We build our whiteboard of fundamental ideas so we're ready to act when the risk monitor changes. The risk monitor is stage 2. That's basically your algorithmic expression of what the market's doing. And we try to identify a confluence across indexes. So we follow 7 major indexes, the 4 primary, S&P, NASDAQ, Dow, small caps, and then 3 secondary, momentum, value, and the IBD 50, which are the innovative stocks. When we see all of them moving in a herd mentality, we usually get the highest probability of success making a decision. And then, of course, the 3rd stage is stop losses. We always have to protect ourselves from our own egos, from our own biases, and all these other things. All right, so let's dive in. Let's deal first with the risk monitor because that's the big elephant in the room, so to speak. So the risk monitor changes to yellow. It's not a risk monitor green today. I can't get it green. Won't go green. And it won't go green because we have real devastation in leading growth stocks. We have a correction unfolding in like crypto, which is these are harbingers of overall market strength. So when you get leading momentum stocks, innovative stocks, leading risk on type of ideas, which are like the crypto names, all going through some type of a correction, it generally leads to bigger market correction, right? So the risk monitor only goes green when we see confluence across the board. It goes red when we see confluence, right? Money is coming out of the whole market, we go red. Money is coming into the whole market, we go green. So right now we're at this odd moment where we're going to have to go yellow because we recognize that all 4 of the major indexes that we follow, and we were kind of waiting for the Dow to join the fray, and it joined it right here. I'll get to that chart in a minute. That's the energy chart. But so what we have is a rising wedge on the Dow, and it took yesterday's action to turn it positive. So we have this single stock algorithms, right? Single index algorithms. And then we combine them for the risk monitor changes. Okay. So from a single index algorithmic point of view, the S&P, the NASDAQ, small caps, and now the Dow are all saying the market should go higher. So when we get the top 4 speaking in unison, even though it was a little bit more ragged than we would like, what do I mean by that? A risk monitor green, everything goes positive within like a 48-hour window. And the big 4 usually go positive on the same day, maybe the next day, that 48-hour window. So what happened here is it was like a rolling move higher. And I'm going to get to why in a minute. There's a lot of cross currents. So the end of the year has a lot of weird behavior. But anyway, it's led to the 4 finally telling us, yep, market's going higher. So we don't necessarily care too much. We see this rising wedge, but it doesn't stop us from changing. We don't really look at that from an algorithmic standpoint. Although I look at that and I say it's such a clear rising wedge. I'll be shocked if the market really skyrockets from here, but you never know. And so we just execute. So when we get risk monitor yellow, what does that mean for the portfolios? First of all, let's just break it down real quick before I jump into how we change each portfolio. Let me just say that I'll talk about cross currents at the end of the year. So what's kind of kept us a little off balance and why the risk monitor can't go green is we have these, kind of cross currents. Number one, as I've already described, there are just these clear bearish, bigger picture actions in the market. Devastation in leading growth stocks, innovative stocks, breakdowns in leading risk on type of ideas like crypto, these types of things. These are usually drags in the market. And a clear underperformance from small caps, which are always the canary in the coal mine. Now, small caps have joined the fray here, okay? So they're trying to come off of the lows and stay within this pattern here, okay? So this is like an 11-month pattern of really consolidation. So even though the big indexes have marched higher, the canary in the coal mine has been going through distribution almost all year, complete with a breakout failure. Okay, so that's not really what you're looking for in the sector of the market that generally is the canary in the coal mine, right? The small cap stocks usually break down first, usually go through distribution first. And what's happening is market participants are driving the market higher by distributing out of growth stocks, innovative stocks, crypto stocks, small cap stocks, and focusing on the top 7 names in the NASDAQ 100 and the S&P 500. Apple, Google, Microsoft, NVIDIA, Tesla, right? Those are the names that are carrying the whole market. That's called a narrowing of the market. It generally doesn't end well. Okay, so we have these bearish, setups. We've got what I just described. We have a Fed that's supposedly hawkish, which usually leads to weakness in the market. At the very least, it's an erratic market when the Fed's talking about reducing liquidity and raising rates. So these are the cross currents, right? Those are the big picture kind of bear issues. On the bull side, hey, it's the Santa Claus rally. I mean, it's the rally that absolutely everybody knows and expects. So I hate getting on the side of a trade that everybody is expecting, but it's working right now. Sometimes it's a self-fulfilling prophecy. Okay, how long it'll last is, suspect. I've seen many year-end runs like this, and on the first 3 days of the new year, the market gives it all away, and you get a 3 to 5% drop in the market literally in the first couple of days of the trading session of the new year. Okay, so a lot of cross currents. We know there's a Santa Claus rally. It's unfolding. We trying to remember, like, what are the bullish, and I like to create in the ARMR report what I call the captain's log, and I write this down before I chat with you for this very reason. So when I forget something, I can take a look. Oh, yeah, right. So, okay. The Vanna flows, okay? When we get to the end of the year, the last 2 weeks of the year, leading up to big OPEX, which is the end of year options expiration, volumes on equities plummets, right? The volume is just non-existent. So we're getting a declining volume rally from the put wall. At the start of last week, we were at the put wall to the call wall, which is what we're at right now. So what you're seeing right now is a rally into the end of the year to a strike price, which is now somewhere between, let's call it 4,700 and 4,800. Okay, just rolled up to 4,800. So that's a bullish thing when it rolls higher. All right. But we're trading close to those levels now. So you're right up to where all the option to action is. And what you've done is trade from the bottom of the level to the top of the level. So you're in this basic trading range. And I like to say that at this time of year, the option tail can wag the equity dog. There's just not a lot of equity trading. I mean, the volume yesterday plummeted off. I mean, market was going through the roof and the volume was like cratering on the indexes. Okay. So what you're getting is this Vanna flow up to a key level. And the question is, what happens from here? Because now we're at the call wall. So how much more fuel is there in that tail wagging? And then do we get back to reality? Does it happen by the end of the year? Or does it happen early next year? I don't know. So we get this Vanna flow into the end of the year. And then, of course, one of the reasons for the Santa Claus rally is people front run what they know every year is a pension dump. Okay. Pensions get funded at the end of the year. And this is usually why January and February are, there's a decent rally somewhere in January and February, because a lot of money gets put in money managers' hands and they go put it to work. They're not market timers. They just get a bunch of cash from pensions, put the money to work. So these are money flows that are generally positive this time of year. So those are the cross currents. You get these positive money flows. You got the Vanna type of tail wagging the dog situation as volumes collapse on the underlying equities. But at the same time, we know Fed hawkish, rate hikes in the first, taper in the first quarter, rate hikes somewhere in March. These are not good things for the market, right? So risk monitor yellow. So what does it mean for our portfolios? We have an index-only portfolio where all we do is use the risk monitor to buy the indexes. Okay, that portfolio is 100% cash. It's not changing. We don't care if the market goes up for a couple of weeks without us. If the risk monitor is not green, we don't put money to work in that portfolio. Sometimes it underperforms. Other times it dramatically outperforms, and it follows its own path. It's not a portfolio designed to be in the market just because the S&P is going up. We're looking to find high probability entry points where reward's worth risk. This isn't one of them. It stays in cash. Then we have the ARMR 1 portfolio, which is geared towards using our whiteboard. We've been really working on that hard the last month, collecting what are our favorite names, our favorite sectors. And when we get a risk monitor change, usually it's green, this time it's yellow, but it opens the window to cautiously put some of that money to work. Look at the whiteboard, find the individual names we like. I'll go over them in a minute. I'll show you a couple names. Put them in the portfolio. And also group ETFs, right? So sometimes we want to own the stocks. Other times we want to just express an opinion about a group, and we own the ETF. Then we have ARMR Portfolio 2, which is focused on strictly following and executing the ARMR algorithms. So we don't buy individual stocks in that portfolio. We day trade a significant amount of that capital, something like 40%. We'll swing trade about 25% of that portfolio in the indexes. We can't put that money to work right now because it's risk monitor yellow. That's not green. That money only goes to work when we get green. Okay, so can't put it to work right now. And then what we'll do in there is we'll own a couple of key group ETFs. Like for instance, right now we own gold and silver, Sprott gold and silver funds in that portfolio. So we'll do some group moves with some of the assets. So it's basically indexes, groups, and day trading. And I'll share with you a trade from yesterday. We've been making money consistently, day in and day out, trading the indexes, using a simple process of the ARMR algorithm for day trading combined with spot gamma information. I'll show you how we did it in a minute. Because it's just so clear from yesterday. It was like just such an obvious setup. And I'm building for all of you, for all ARMR insiders, a playbook. Right? There's just so many ways the market can open every day. And I'm going to show you what I mean in a minute. And when we see that type of open, we go to the playbook, we figure out one of these 3 or 4 setups is going to occur. If it does, high probability entry point, put the money to work, execute. That's it. Get rid of your ego, get rid of your opinions of what you think the market's doing, and just execute. That's how you make money day trading. So we're going to keep doing that in the ARMR portfolio too. And then, of course, we have a dividend portfolio. That doesn't follow the risk monitor at all. Okay? It's strictly designed to capture yield at the right moment. So we have a curated list of stocks we're looking to buy. We wait for weakness in those names that jacks up the yield. And when we get the entry point using an algorithm, boom, we put the money to work. And then we hold that position as long as we can. We use weekly stops, not daily stops. We don't exit positions just because the risk monitor goes red. So a certain portion of the portfolio will always be invested collecting yield. These 4 tools, this is how I run my own money, just so you understand. I have portfolios set up like that. So a portion of my capital just keeps collecting yield. It's been the best portfolio for me for the year. When I look at my capital, that portfolio has done the best, right? Because it hasn't traded in and out. It just collects yield. The S&P is up 20%. The net worth of that portfolio is going up while I'm collecting yield. Some years, that's the best portfolio. So you've got to decide how you want to run your own portfolio. I share with you the 4 that I manage. So I break my capital up into 4, okay? If you want a blended approach and you want to always be participating, then you want a piece of all of that. Styles of management, diversification is what will create over a long period of time a more blended return, okay? So you can consider that. So that's how we're going to be changing the portfolio. Let's dive in real quick to a review of yesterday's day trade of the small cap index, okay? Because this is just classic. And we do this every day on the trading desk. We look for these setups and we put the money to work. Now, we made money on all 3 of the indexes, the S&P, the NASDAQ, and the small caps. I'm going to share with you the small cap trade because it's such a classic setup. Now, I'm just going to open it up for you like this. All right, so this is the trading session. So the market opens flat. This is a flat open after strength. This is a flat open. Okay, this is the breakdown from the prior day. What you're looking at right now before I go through this is a 3-minute chart of IWM. Okay, we trade you could trade IWM, you could trade TNA, you could trade, all different, whatever index you're most comfortable trading, the triples, the doubles, whatever, or just IWM. But I share with you IWM because that's the chart we use for all of our decisions, and then how we express the trade. You can use options, you could do whatever you want. So what we look for, the purple lines are the spot gamma locations, those purple dashes. Everything else is an ARMR algorithm we call the price movement profiler. So we see the opening range, high and low and mid range of the green, the yellow, okay, the red. The red lines below are Fibonacci extensions. The green are Fibonacci extensions above. We use the volume weighted average price, VWAP right here with standard deviations above and below. I call them all ARMR because they're regular off-the-shelf VWAPs, but then we infuse volatility components into all of these indicators. And then we use the ATR highs and lows, okay? So what we look for in the morning is this sell-off after a nice strong close the day before, opened flat and sold off right down to the spot gamma location, which was the volatility trigger, okay? You see a double bottom at the volatility trigger. It doesn't get more obvious than that. At 10 o'clock. So the first half hour sets up a double bottom. The buy trigger for us is the move above the VWAP. So we're getting long right there, right? And then the target was the 50-day moving average. That's what this black dash line is. And you can see it went right to the 50 and stopped until, of course, the melt up in the last 15 minutes. Okay? But basically the 50-day was the target, and that's where it went. So that was the most logical day trade. Okay. And so we look for those setups every day, and we'll be doing it again today. And I can't really tell you what the setup will be. I don't know. We have to wait, see, market will open. We'll get today it looks like a little bit of a gap up. We've had a couple of gap and go days. Let me show you what I mean by that. We also were long the S&P yesterday off the open. So this was a different setup. See, there was no selling in the S&P yesterday. So this was a little more tricky. I don't really like this gap and go days, but you can get gap and go days after a couple of strong moves and you're running towards the call wall. You can get a couple gap and go days. So the market sold off at the close the day before, gapped up in the morning. So that's your gap. Then it makes a consolidation for the first half hour between the VWAP and the opening range high. And then sometime after 10 o'clock, and this happened right around 10:06, so it's pretty much right on cue, you break to a new high on the day, taking out that consolidation structure, and that tells you get long the market. Now, the expectation for me on that particular day was the third fib up on the day. I didn't really expect it to keep running like this. So I booked my profits a little bit too soon. That's okay. The stop was right in here, and so it never went below the raised stop, okay? So we could have stayed long all day. But I exited, took my profit off the table. Sometimes you do that. And really I strive, guys, to stop my own opinions from getting in the way of a trade. It's so hard to do. It takes massive discipline. So my opinion yesterday is I don't think the market's going to keep melting up. That was totally wrong. So I booked my profit a little too soon. So the mantra going into trading every day: have no bias, have no ego, don't remember anything about what you did yesterday. Just execute what you see today. Read and react. You get your trigger, you put your trade on. You don't look at your P&L. You don't worry about whether or not you're going to be right or wrong. You just execute. And day after day after day, we're taking money out of the market trading like this. All right, so let's dive into a couple of stocks that we have at the top of our whiteboard. So I call these top shelf names. They're at the right locations for a new buy opportunity, and they're investments we've done research on that we're happy with, that we think we'd like to own. So we may be adding these to the portfolio. I'm just going to rip through them with you. Top two on the top of the list have to be the energy. So we know the uranium story. It got a little bit ahead of itself, pulled back, set up a double bottom at the 200-day moving average. And the buy signal really was yesterday. And when we close this far away from the VWAP, I tend to wait to see if I can get it a little bit cheaper the following morning. Right now, it looks like I'm going to have to pay up for it. So it's going to gap up above the 50-day moving average. So we'll see how it opens in the first half hour. Maybe the first hour, we'll look for some type of weakness down to a test of VWAP, and we'll put on some URA. XOP. Okay, so URA and XOP kind of go together. We have an energy move that's coming. And so what you're going to notice in the portfolios, really we have energy, which is uranium and exploration production companies. We've got gold and silver in the portfolio, the hard assets, not the mining stocks. And we've added these three names to our dividend portfolio yesterday. So we're buying the pipelines. Enbridge, 7.1% yield. 6.3% on Williams, right off the 200-day moving average down here. See that? Pulled right. So we had this name on our list. We wanted to own it for a long time. It kind of ran away here. Finally comes back down right to the base, right to the 200-day. That's where we want to put the trade on. One Oak, another 3%, a 6.3% yield. Same situation. So it kind of ran up here and it's pulled right back down on top of the base. Yield pops back above 6%. We want to own it. We already own KMI. So it makes 4 pipelines in the portfolio now. Okay. So what you're seeing is a shift for us really into some commodity names, because that's where the setups are that work for us. So uranium and exploration production companies will be the first place we go. So does that mean, you can buy CCJ? Absolutely. Same. Look, you can own the ETF or you can own a couple of your favorite names in this space. I'm going to be owning the ETFs. I'm comfortable doing that. I'd rather take a larger position in the ETFs than take smaller positions in a handful of different stocks in this particular case. Now, if you could show me, when it comes to commodities, I usually do that. I don't want the risk of an individual commodity name. What I want is exposure to the commodity play, and I'd rather put a bigger position on the ETF and collect all of the position, all the exposure without worrying about single stock risk. When it comes to innovative growth stocks, I'm going to buy the individual stock, because in that case, I'm buying a company with the intellectual property, the moat around the business, the high margins, the great management team, driving growth. That's a whole different way of investing. But when it comes to commodities, I'm more content owning the ETFs. But anyway, so there's CCJ. And could you use like Apache as your idea? Absolutely. Look, Apache looks phenomenal. Huge breakout yesterday. But Apache and all of these names are in XOP. And of course, if you want to get real aggressive, you could own shares of Gush, which is 3 times XOP. Okay. Now, I think XOP's got enough volatility by itself. But if you want even more volatility, you can own some Gush. You still don't have single stock risk, but you certainly have returns that will blow away the average individual exploration production stock. So, pick your poison when it comes to risk. The 3X or buying an individual name, that has issues while the rest of the group goes up. It's totally up to you. But that's the setup. That's the entry point. The low of yesterday is the stop on these positions. Okay. Now, just rifling through some of my favorite names. Let's go big cap real quick. Okay. Facebook is, I think, the best looking big cap name that just broke out. Actually, the entry point's yesterday. So the low of yesterday is the stop, and wherever we pick it up today, the low yesterday would be the stop there. Microsoft, I don't know if you want to do this because, you may as well just own the index, but I'm not going to load up my portfolio of big cap tech, but there's Microsoft. Looks like it's trying to break out. My favorite thing in the portfolio that I'll be looking for are my dynamic growth stocks, my innovators. Top of the list is Trade Desk. It's got the right chart pattern with just blowout earnings. This is a huge stock and I want to own it. So that's, first into the portfolio, followed closely by Roblox. So I'm watching Roblox closely. This isn't the greatest chart pattern. It's had a huge sell-off, which is great. It's an unbelievable growth story, but Metaverse is not front and center right now for what I want to own. But it looks like this thing has come down and made a double bottom in the 95 area and closed above the 50-day. So I have my eye on Roblox. I might want to own it only because I think that growth story is open-ended. I'm a fan of Datadog. And if you look at that chart and you look at MDB, they kind of look the same. It's a little ragged. It's a little bit too far away for me to add them right here. But on weakness, I could see myself adding those names. Okay. So those are a handful. Let me just add a couple more before I take any questions. You got to respect that AMAT chart. That's a sick breakout right there. Now I'm a little bit late. The real entry point was 3 days ago, so I can't pay up for it. But do I buy some on weakness? Absolutely. Microchip, same exact chart pattern, same breakout. 3 days ago was the entry point. I'm a little late. I'll wait. But those two charts are just front and center for me. They really look great. All right. So those are my thoughts for this morning. That's how I'm going to be trading this morning. We'll be day trading the indexes like we do every day. We'll be looking to selectively put some capital to work off of the whiteboard from our innovator names. We're going to put some capital to work in group ETFs that are focused on commodities. I just running through my traps this morning. Even something like the steel stocks starting to look interesting again. Of course, Nucor is the best way to go about that. But our old friend CLF right on the 200-day. And U.S. Steel, I haven't looked at that, but what is that trading? Right? Oh God, look at that double bottom on the 200-day. I mean, that's the time to buy the steel stocks. So I can see commodity plays. They really are starting to look solid, and that makes sense going into 2022. So do I want to chase the last couple of big cap techs in the stratosphere? Not really. But could I see myself buying the steel stocks, the energy stocks, the uranium stocks? Definitely. So that's my focus. I hope it helps. Any questions you guys have, I'm happy to take a couple of questions. ARMR Insiders, anything you got for me, just shout it out. All right. So Chad's giving us a heads up on Digital Turbine making a double bottom in here, cutting a deal with Google. So that's something we can put back on our list to take a peek at. Interesting idea. We could buy MPLX. Brian is saying to capture all of the pipelines. Yeah, and that chart looks great. Another great idea. What's the yield on that, Brian? If you can grab it and put it into the room real quick, I'm curious what the yield is on the whole thing. And does it have a K1? I mean, the reason why I don't own that is because I don't like the K1s. So the stocks that I've bought, the big four that I'm buying, they have a high enough yield to make me happy, and they're not MLPs, so I don't have to worry about the K1s at the end of the year. And so that's why I focus on those four names. But there's certainly other ways to go about it, and if you're content to deal with the K1s, then those are pretty good ideas. Question. Okay, Spock Emma says probably until 31st option. What do you think? So going back to the question about year-end rallies. So we're right up against the call walls now, although they may roll higher. I don't know. We'll see. It's really anyone's guess. I mean, it probably. I don't really like to make the prediction because I don't want that to change how I trade, to be honest with you. So I don't know. I don't think anybody knows what the market will do between now and the end of the year. It's in an uptrend. It's had a huge run in the last week. It's had that huge run based on Vanna rallies because it's certainly not based on institutional investing. Volume's fallen off of a cliff, right? So whenever that Vanna rally is exhausted, the trade's over. Could that spill over into the first week of next year? It could. Is it over today? It's possible. We just don't know. So we'll have to read and react to what the market's given us. If there's short setups, I'll be short today. I won't not short just because maybe the market will rally all the way to the 31st. I'm just going to read and react to what I see. And I think that's the best thing for us to do. AMC stock. I really like the growth story on AMC, but it's got nothing to do with the growth story and everything to do with the options positioning. So I don't have any interest in AMC. I love AMC. I think it's a great story, but it's not trading on fundamentals at all. It's trading on massive options flows. And right now, those flows have rolled lower, and that's what's driving the stock down. So if we see the options walls start to trade higher and things start rolling higher again, hey, man, sky's the limit because I think the fundamentals are great. Everyone's going back to the movies. But anyway, what else we got? Yeah, I don't know what that is. I'm just ignoring. I don't know what that is. So I'll just ignore that. And we'll wrap up right there, okay? So I wish you all a great trading session. Be nimble, my friends. Stay nimble. Don't get locked into a particular opinion, okay? Because if you try to force your will on the market, it'll run you over. All right? So we're going to read and react. We say the risk monitor has changed to cautious. We could put some money to work, see how we do. We start getting paid on that, we can be more aggressive. All right. But a lot of cross currents. And quite frankly, there's nothing wrong with not participating in a melt up. There's nothing wrong. The market always gives you another opportunity. 2 weeks ago, the market was imploding on big volume. 2 weeks later, the market runs from the put wall to the call wall, and everyone thinks everything's okay. Be patient. You'll get your shots, and when you get them, you take them. Have a great trading day. I'll see you guys on the flip side.